There's no doubt that having an emergency fund is a good thing, especially as a small business owner. Today, we're going to talk about how to build an emergency fund outside of the bank to put you in more control of your finances as times get tough. Hi, I'm Olivia Kirk.
I'm Tim Urich. We're from Tier 1 Capital, and we're here to show you how to regain control of your money. According to a study by Intuit, 61% of small business owners suffer from either chronic or cyclical cash flow issues. And here's the key. What we have found working with small business owners for over 40 years, all of these cash flow issues are self-inflicted. They emanate from how we have been trained to use our money. And the key here is we have a process where we can show you how to reverse the flow of your cash flow that is now you've been trained to have that cash flow move away from you. And now we just reverse the flow. So now the energy is flowing back to you.
And the best part about this condition being self-inflicted really is that you are making decisions that led you down one path. And by changing how you're using your money, you're able to lead yourself down another path, a path that gives you more access to capital. And you're not under the mercy of the bank anymore, right?
Exactly. And not only does it give you access to capital, it gives you independence from the bank. It also gives you freedom to be in control of the repayment process because you're borrowing against your own reserves rather than asking permission and getting approval from somebody else to tap into their reserves.
Exactly. So using these whole life insurance policies designed for cash value accumulation is really taking a step to build up a private pool of capital that you have full liquidity, use, and control over that you're able to use to self-finance in your business, right? So now instead of making payments to the bank, you're making payments to the insurance company and rebuilding that access to capital as time goes on.
And that's such a strong point because, again, as you're paying down your loan, you're also simultaneously increasing your equity. So you really continue to keep this process and this momentum growing, and the financial energy is incredible. And now that puts you at a distinct advantage against your competitors, against your peers, and it also positions you for growth to be able to take advantage of opportunities.
Exactly. And, there's a few things that a business owner could use that capital for that I could think of, right? So we have the emergency fund. If cash flow comes tight and we need to cover monthly expenses, we could certainly tap into that cash value. We have the ability to tap into that cash value to self-finance purchases, whether it's inventory, you're able to buy inventory at a discount, maybe a large piece of equipment, you're able to tap into the life insurance policy loan, and you have much more control over, number one, whether you're able to access the money, and number two, the repayment schedule that goes along with that. And then number three would be if you want to expand your business, maybe open a new location, you're able to tap into the life insurance policy loans to take advantage of opportunities that may come up.
All we've discussed thus far in this video is the practical applications of the cash value. But now you also have to realize that the death benefit's important. And whether you purchase the policy for succession planning, exit planning, or key person retention planning, you're now getting $1 doing multiple duties. And that's the way you beat recessions and inflation. You get $1 to perform multiple duties.
Yeah, and let's take a step way back here. How would a business owner go about, because, when we talk about whole life insurance, people think about premiums. How would someone start funding a whole life insurance policy? Let's say if they are cash flow pinched and don't have access to capital on a monthly basis and they feel like they need the money to take advantage, and they feel like they need the money to get out of this situation, but don't have the money to set aside in a whole life policy.
So that takes, like Nelson Nash taught me, it takes honest introspection. You have to really take a look at how you're using your money. Because we have been trained to transfer control of our money and our cash flow unknowingly and unnecessarily. And if these are two key words, because unknowingly means we don't realize it. The reality is we think it's moving us forward, but it's actually holding us back. And unnecessarily means that you could stop doing it. And when you look at things with honest introspection, you're able to discern whether or not it's actually moving you forward. And if it isn't, and you're not in control, all of a sudden, if you just stop those strategies or those uses of your money, now you're in control.
Yeah.
And that's the key.
Exactly. And you know, one of the things that we've been trained to look at when we're looking at how we're using our money is interest rates, right? How much is it going to cost me in interest? And how could I pay less interest? I don't want to give up control of that money. I want to pay it off as soon as possible. But a lot of times by taking that step, and let's say you're putting $1,000 extra on a loan to pay less interest in the long run, what you're actually doing is giving up control of that $1,000 today that is actually leaving you feeling pinched. So it doesn't matter necessarily that you're saving a few bucks on interest if it's not giving you a feeling of financial freedom, right? How could we better use that $1,000 to move us forward, take advantage of what we actually need now, as well as set our business up for a better situation in the future?
And ultimately, the bottom line, you got to be in control. Because if you're not in control, somebody else is.
Right. So when you give that $1,000 to the bank, you no longer have liquidity use and control of that $1,000. The bank does. And if you want to get your hands on it, now you have to go and ask permission, which isn't a good position to be in when you're looking to be financially free.
Yeah. And, it's funny. A lot of times when we're sitting down with business owners and we're talking about funding their succession or their exit or their key person retention plan, and they're like, well, we don't have the cash flow for it. I always tell them, you probably do, but you got to make some changes on how you're using your money. And a lot of times, some people take exception to that statement. We don't mean it critically. We just literally mean like, you've been trained to use your money differently. And if you unlearn those bad habits, all of a sudden you could be in control.
Right. And what we're really doing at the end of the day is moving money from one pocket to the next, right? Instead of giving the money to the bank, we're just putting the money in the life insurance policy to build up that private reserve, that pool of capital that you own and control, that you're able to access to take advantage of opportunities, to move your business forward, to get yourself out of a cash flow pinch instead of trying to save an extra couple bucks on interest. So at the end of the day, the choice is simple. You either want to get out of debt as soon as possible, which is going to leave you cash poor, or you want to build that emergency fund that you have full liquidity use and control over. And at the end of the day, there's only a few places where you could store that emergency fund, right?
There are a lot of similarities between banks and insurance companies. I mean, think about it. They're both financial intermediaries, meaning that they take our money, they invest it for profit, and then they stand in the middle guaranteeing us against loss. Now, both banks and insurance companies are insured by some type of government program. Of course, banks are insured by the FDIC and insurance companies are not. But insurance companies are insured by each state's insurance guarantee fund. So think about this. The FDIC insures your bank account up to $250,000. And here in Pennsylvania, the State Guarantee Insurance Fund guarantees your account up to $250,000. So there are a lot of similarities between banks and insurance companies. But there is a key difference, and it's how they're allowed to reserve money. See, a bank is set up on a fractional reserve system, which means for the bank to guarantee that you get your dollar that you deposited with the bank, they only have to put aside about 10 cents. An insurance company works on 100% reserve requirements, meaning that if you have $1, they could only loan you that dollar. They can't loan you $10 like a bank. So your money is much safer with an insurance company versus a bank because of their reserve requirements.
If you'd like to learn more about how to build an emergency fund using a whole life policy designed for cash value accumulation that could also serve other benefits for your business, check out our website at tier1capital.com. Schedule your free strategy session today, and we'll talk to you specifically about your scenario. If you like this video, be sure to give us a thumbs up and check out these two. We picked them out special for you.
Thank you so much for watching our video. And remember, it's not how much money you make.
It's how much money you keep that really matters. We'll see you in the next one.